Good morning. Here is today's Korean economic news briefing. The global economic landscape is currently dominated by escalating geopolitical tensions in the Middle East, specifically the conflict between the United States and Iran. This situation has pushed international oil prices to alarming levels and sent shockwaves through global financial markets, with South Korea feeling significant immediate impact. In response to the intensifying Middle East crisis, which has led South Korea to raise its economic crisis management level from attention to caution, the government and ruling party held their second task force meeting on economic responses. A key action is the immediate full activation of energy stabilization measures. This includes preparations for releasing strategic petroleum reserves, mirroring actions by International Energy Agency member countries as the crisis in the Strait of Hormuz intensifies. The government is carefully reviewing the timing and methods for releasing its 22.46 million barrels of reserves. Furthermore, domestic energy policy is being adjusted. The 80% cap on coal-fired power plants has been lifted starting today, and preemptive supply management for LNG will be enhanced through expanded use of coal and nuclear power. In an effort to curb speculation and ensure market stability, the government also announced strengthened oversight of discount gas stations with a one-strikeout policy for maximum oil price violations. This energy shock has had an immediate and dramatic effect on our financial markets. The $1 exchange rate, a critical economic barometer, opened today at 1,501 won to the dollar, briefly breaching the 1,501 mark during intraday trading for the first time in 17 years. This is a level not seen since the 2009 global financial crisis, marking the third major wave of currency instability since the 1997 Asian financial crisis. The surge in international oil prices past $100 a barrel, coupled with heightened safe haven demand for the US dollar amid global uncertainties, has fueled this depreciation. This high exchange rate significantly increases the cost of imports, particularly crude oil, exacerbating inflationary pressures and raising concerns about corporate profitability. The bond market also reacted sharply, with 3-year Korean Treasury bond yields hitting a 21-month high. To stabilize the market, the government and Bank of Korea are taking swift action. The government indicated it is prepared to conduct emergency buybacks of Treasury bonds if necessary, while the Bank of Korea already carried out a record-high 3 trillion won outright purchase of Treasury bonds last week. These measures aim to curb rising interest rates and maintain financial market stability. Looking at the broader macroeconomic picture, the outlook remains challenging. Oxford Economics warns that if oil prices average $140 per barrel for 2 months due to the US-Iran conflict, global inflation could soar to 5.8%, potentially pushing the US economy into recession. They project both US and European central banks may need to raise rates by 0.5 percentage points. Even China, grappling with disinflation, faces significant burdens from surging oil prices, threatening real economic pain despite a slight fall in its producer price index. Domestically, there are calls for a supplementary budget to mitigate the economic fallout, with the Democratic Party planning to submit a proposal to the National Assembly this month. Regionally, Daegu and Jeonbuk reported decreased employment and increased unemployment in January, signaling economic vulnerabilities. Despite significant headwinds, the Kospi opened slightly higher today, showing specific sector resilience. While caution prevails due to high oil prices and the depreciating won, select industries are demonstrating strength. Semiconductors, defense, aerospace, biotechnology, and nuclear power-related stocks have seen notable gains and even new highs. This suggests that while broad market concerns persist, investors are seeking out sectors that may be less susceptible to the immediate impacts of energy costs or even benefit from the geopolitical environment. Analysts anticipate continued volatility, heavily influenced by the US-Iran conflict, oil prices, and the upcoming US Federal Open Market Committee meeting, including Chair Jerome Powell's remarks. Internationally, this week is a super week for central banks, with the US Federal Reserve, European Central Bank, and Bank of Japan holding policy meetings. While the Fed is expected to keep rates steady, escalating oil prices and inflation could shift future monetary policy. Former US President Donald Trump has reiterated his stance on imposing global tariffs, adding uncertainty to international trade. Geopolitically, while the US is preoccupied with the Middle East, China is actively strengthening alliances, as seen in a new 3+3 strategic dialogue with Vietnam focusing on diplomacy, defense, and public security. The US-Iran conflict is expected to last several more weeks, with potential attacks on key Iranian oil facilities like Karg Island further threatening global supply. This will also significantly impact travel costs, with international flight fuel surcharges expected to triple or more next month. In domestic industries, some sectors are facing significant challenges. SKC, a major player in battery materials and petrochemicals, announced voluntary retirement packages, citing an EV chasm and a petrochemical industry downturn. This aims to improve cost structures and operational efficiency. In the real estate sector, new apartment supply in Seoul remains dominated by reconstruction and redevelopment, but overall supply has decreased due to project financing constraints. While Seoul's home price increase slowed in February, many new apartments are priced significantly above market rates, leading young buyers to cancel subscription savings accounts. Finally, on a more forward-looking note, the role of artificial intelligence in the economy continues to expand. The Ministry of SMEs and Startups is pushing for small business growth and re-establishment, emphasizing local entrepreneur nurturing and AI training expansion. Companies like Syntecabio expect performance growth from AI drug development platforms, highlighting AI's R&D efficiency gains. Major telecom companies are accelerating AI transformation initiatives, aiming for a one-person, one AI agent era to boost productivity and expand into new AI solution markets. For investors and general viewers, the immediate future appears marked by high volatility and uncertainty, driven primarily by the Middle East conflict's ramifications for global energy prices and currency markets. Vigilance regarding inflation and central bank actions, especially the upcoming FOMC, is paramount. Investors may find opportunities in resilient sectors like technology, defense, and potentially alternative energy, while defensive strategies might be prudent. For general viewers, brace for higher energy costs, increased import prices, and potential interest rate adjustments, all impacting household budgets and economic activity. That concludes today's economic news briefing. Thank you for joining us.